If you happen to be listening to a channel on YouTube that is entirely dedicated to business and economics, I can state with a level of knowledge that is very close to absolute that you have watched The Wolf of Wall Street no less than a dozen times. It's a fantastic movie, and seeing it has inspired a lot of young men to go into the field of sales. It doesn't matter though, because you've got me on your side. Welcome to the Financial Flow. Please like and subscribe to our channel and turn on notifications to stay up on our latest videos. After being let off from his position at LF Rothschild, a stock brokerage firm located in New York, Jordan Belfort's career took off in a significant way. Before the year 2000, it was not possible to acquire stocks by just going online and typing in the ticker symbol for a company. People used to call a real person, who was known as a stockbroker, and ask for advice regarding which stocks they should buy and which ones they should sell. The majority of the time, the stockbroker would call their customers and advise them over the phone on what they should purchase and sell. The same held true in terms of acquiring information. Simply typing, "How much does GME cost in 2021" into Google is all that is required of you if you are interested in obtaining this information. In the 1980s, the only way to find out what was happening in the market was to either wait for the paper to come out the following day or to phone your broker. Now, as Matthew McConaughey so insightfully points out, nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if a stock is going up, down, sideways, or in king circles. Least of all, stockbrokers. So why did they do this then? Matthew McConaughey quoted in The Wolf of Wall Street, "You and me brokers, we're taking home cold hard cash via commission." Yes, that's right. By handling these trades, they made a lot of money in commissions, although there are now many brokers who do not charge any fees. This was not always the case in the past. In the 1990s, it was not uncommon for the overall cost of a trade to equal up to 2% of the total value of the assets that were being transferred. Typically, a stockbroker would receive 1% of that amount, while the company for whom the stockbroker worked would receive the remaining 1%. At some point in the future, Jordan Belfort would find employment at that investment center. Although Jordan has worked for a few companies in real life that are similar to those depicted in the movie is quite realistic about how these types of enterprises operate. Over-the-counter brokerages are what these are, which are very different from brokerages like LF Rothschild that deals with exchanges. Exchange brokerages make it easier for people to trade on public markets. They would have real people on the floor on the NYSE who would call out trades for the stockbrokers in their office, who were relaying trades from their clients. This mechanism was nevertheless vulnerable to dishonest activity, as we had seen mainly in the form of stockbrokers driving their clients to make as many trades as possible to drive up their commissions. But in order to prevent things from getting out of control, the exchange exercised some amount of control over all of the participants in this game. The exchange had the power to eject a single stockbroker or stockbroking company from the trading floor if it determined that their actions were harming the reputation of the exchange. The stock brokerages would be destroyed as a result, since they would be unable to conduct business. Exchanges also place strict restrictions on which businesses can list on their exchanges. They investigate the management's backgrounds, audit financial documents, and make sure the company's CEO's mother doesn't answer the phone when you call their corporate headquarters. The companies sold over-the-counter are unique. Since they don't use unexchanged services, they can do without a lot of the associated regulations and oversight. Companies can approach these over-the-counter firms directly and say things like, "Hey, I need $5 million in funds to overtake R&D on a new piece of radar gear that has both defense and commercial applications." The brokerage firm may respond positively, "Yes, but we got 50% of all the money we generate for you." In the best case scenario, these businesses are just starving for capital to implement their ideas. In the worst case scenario, they are also attempting to scam investors using the funds they raise. The 50% statistic was really a little of Hollywood magic, added in there to give the story one more dimension. The gains that the OTC brokers made from these deals were most likely between 10% and 20%. If a company needs to offer a stockbroker a 20% cut of its profits in order to obtain cash, it is highly improbable that investing in the company will be profitable under any circumstances. This should go without saying. Because of this, Jordan Belfort and his accomplices utilized high-pressure sales techniques on investors who were not well informed. Jordan later established Stratton Oakmont, a division of Stratton Securities, a small-time dealer with the ability to trade both over-the-counter and exchange-listed businesses. The financial situation in Belfort had been favorable. Despite this, he aimed far higher for himself. After that, he engaged the services of a team of brokers who would vigorously promote any stock he directed them to. Before giving this order, he would make calls to reliable acquaintances who were not connected to him, and who would acquire a sizable amount of shares in a small, high-value firm, preferably one with a market valuation of less than $100 million. He would tell all of the brokers of his sales floor to go out and sell the stock to whoever would buy it after his connections or rat holes owned a sizable enough piece of the business. The price would increase as a result of the buying frenzy, which would also have the advantageous effect of making it simpler to sell to new investors. Jordan would give his rat holes instructions to begin selling the stock once the price had reached a particular level. Brokers would be told to deliberately lose trade orders or not to accept calls from investors trying to sell stock while this was going on, and Jordan's company would make it very difficult for its regular clients to sell off the stock. As soon as regular investors could start selling their own stock, the price would fall. This provided the rat holes time to get out of their positions. Then, the rat holes would give Belfort the cash they had earned while retaining a tiny portion for themselves. When Stratton Oakmont began listing companies on stock exchanges, this technique was elevated to new heights. When a business is first listed on a public exchange, it engages in an initial public offering. Although this procedure is filled with laws and restrictions, the benefit to the business is that it becomes much simpler to raise funds from the public markets. Businesses will employ an underwriting company to help them with the process and take on some of the operations risks. The success of the IPO will then be the responsibility of the underwriting company. A successful IPO really merely means that the company sells all of its shares at the predetermined price or more. Businesses typically turn to investment banks for their underwriting. However, Stratton Oakmont was able to persuade a few businesses to adopt their services during its heyday. You would have believed that Belfort's plotting would have slowed down with the return of public exchanges to the equation. He traded over-the-counter equities because he wanted to dodge the regulations and scrutiny that come with these public exchanges in the first place. Jordan, however, didn't let that get in the way of his plans. In fact, he created a system to make the most of both of these systems. Jordan would give orders to his rat holes to purchase stock in a business he was about to go public. After the business went public, he would direct his army of brokers to sell the IPO stock to everyone they knew. The stock price would increase like it has in the past, but now that it was listed on a public market, it would do so more quickly. Other investors who didn't even know who Stratton Oakmont was would get interested in it. People would want to participate in the activity after hearing the news that an IPO was up 50% at open. The rat holes might then secretly sell their stocks while taking advantage of this buying frenzy, making a huge profit. Jordan created the ultimate money-making fraud by skillfully fusing the unregulated nature of the over-the-counter transactions with the innate confidence investors had in publicly listed stocks. If you haven't figured it out yet, this is referred to as a pump and dump, and it was how Belfort amassed his enormous wealth. Actually, it appeared for a time that these schemes were disappearing. Investors were no longer subject to brokers who would hype up some tiny-sized firm thanks to online stock trading platforms and simple access to market information. Unfortunately, pump and dump scams are back with a vengeance due to the development of weakly regulated crypto market. The only change is that today's Discord communities, gaming influencers, and dumb meme coins have taken the role of today's buzz stockbrokers, penny stocks, and stockbrokers. Thanks for watching. Don't forget to leave a like and subscribe to our channel for more content like this. Have a good one.